Oh, no, Killy was coming in too.
I'm leaving.
Yeah, don't. Hey, everybody. I turned off my mute on my.
After this, I'm gonna go install a bunch of handrails to make it FHA compliant. Hopefully, it's then going.
Okay. We're gonna get started in a second, but Amanda's helping me and we have
Recording in progress.
I did sell it a.
You are the host, ma'am.
thank you, Mayor. We have our speakers. Thanks, Amanda.
You are very welcome. Look, pretty lot now.
We're talking about DSCR loans today.
Yeah, I specifically requested an emphasis on that 1099 loan. I know. Link I sent. So the meeting before us ran a little bit over. So people are trickling in and we also have a guest joining. And I'm waiting on them. So the information part of this Zoom will probably really only take about 30 minutes. We are going to have Tyler from NewFi join us. So NewFi is a brokerage. We get to broker our loans out to them through Keller Home Loans. So those are the only ones we don't do in-house, but we are the point person. So the client will be in contact with us. We will be the one that's handling the file, but Tyler's team will be actually underwriting the file. He's a wealth of information. He's available all the time, which I appreciate. So he's going to be hopping on the call to go into more detail because I definitely, like, I've sat in on 2 of his trainings and I know like enough to be able to place the clients in the programs. And they do a deep dive on those trainings and we're not going to do that today. I want you guys to have enough information to see what's going to be a good fit in those one-off scenarios so that you can recognize when's going to be a good time to send them over for one of these products. So for anybody who's not familiar, non-QM stands for non-qualified mortgage. If they don't qualify for a conventional FHA program, those government regulated guidelines, these are going to be portfolio loans at a little bit higher interest rate. That's going to allow them to do the financing they want to do without having to adhere to the government guidelines, basically. So non-qualified mortgages is what we're going over today. He's going to be presenting for about 15 minutes, and then we'll be able to open up for another 15 minutes of questions and answers. And like, it's going to be a lot of information, but a lot of good information. So if there's any like scenarios we want to go over, I would like to hear from you guys, like what kind of scenarios you've come across where you're like, oh, I could have used that. Or maybe you have used them in the past and you've had some successes. I would like to hear some of those specific examples because that could be beneficial to the whole group and how we're going to apply what we go over today. Does that make sense? So just kind of make it an open forum. Oh shoot. Ohio is Central Time. Ohio is Eastern Time. He says give him 5 minutes. Okay, icebreaker. Preston, why'd you come to class today?
I want to learn of loan programs that I can use myself.
Okay.
Invest in, specifically DSCR loans. I know about them and how they work, but just kind of get the more detail.
DSDR, so, debt services consolidation. And what that does is it allows for us to send an appraiser out to the home. The appraiser, on top of the typical appraisal report, also does a separate report to estimate the rent on that property. And so whatever rent payment comes back with that report is what we get to use as the qualifying income. So as long as that rent on the report is $1 more than the mortgage that we're qualifying the buyer for, it's approved. They don't need income. They don't need employment history. They just qualify solely on the cash flow of that property. Does that make sense? So Tyler will go into more on that. Pretty slick, right? Sleeping. And then I really liked the idea of having the 1099 program discussed, as we have a lot of 1099s in the room. I'm guessing all, my household included. So the 1099 program is going to go off of the stated income of your 1099, and I believe it's 75% of that income is what they use for your gross qualifying income. They're not going to collect your 2 years of tax returns, and they're not going to look at all your deductions, because we know that reality versus what we have on paper is not always an accurate picture. So that 1099 loan is also something that could be a good tool personally, specifically for maybe agents that are new to the business and don't have 2 years of history or even one full tax return or something, you know. So Tyler says he'll jump on, but Antonio, why are you here?
Well, actually, I have a client now that's using like the pay stub call.
Yeah,
And that's the first one. So he originally came over, he had a guy that he was qualified, he told me he was qualified with Fifth Third, which is a pre-qual, and
Yeah.
then that lender moved over to Fairway.
okay.
And they tried to do the approval and found out they couldn't, and then this is why, so it's a huge issue. And I'm supposed to close tomorrow on it, but I think it's gonna get pushed.
Yeah,
He paid 1 month, and this is before that, mind you. He paid rent 1 year with a cashier's check, and they were trying to track down the landlord to get a receipt of that.
yeah,
And I think that was the whole, but he, I guess, had no other option because he wasn't paying taxes. He's a truck driver, so he works for himself, which he's got for 2 years, so I didn't really understand the problem, but I think there's more going on behind.
Yeah.
Maybe.
Yeah.
But maybe just to get more info and insight on.
Yeah.
On that, since it just kind of sprung up, so.
So if you can't hear on the video, Antonio has a pain point on a client right now, and they are supposed to be closing tomorrow and hopefully not getting pushed back, but he is exploring is that the 1099 program then? Or just pay stubs? Okay. Another product that they feature is asset depletion. Business owners, they have bank statement loans. So lots of options out there for everyone. Hi, Tyler. Audio checking, it's checking audio.
Okay.
Yeah. Unmute. I don't know how to, I don't like hosting Zooms.
He's on mute. So.
Yeah, and I click the ask to unmute. Ask to unmute. And then
I can get Mark.
I want to make him a co-host there, or make him a co-host. Yeah. Yes. Okay. Hey, making progress. I know, and we probably need some video because he's going to be
There it is. Can you guys hear me?
Hi, Tyler.
Sorry about that. I don't know why I thought that Ohio was on Eastern, or I'm sorry, Central
So
Standard
You're
Time.
so close.
I was close. I just figure it's in the middle of the country, and I guess I'm a little bit, I'm too far west.
I know.
Yeah.
For those of you joining us via Zoom, thank you very much. But you're missing the Coronas because it's nice in the little courtyard out there. We might be logging off after this call to enjoy one in the sunshine.
Oh, there's no light for me. I'm definitely.
Tyler, are you able to test the sound? Because we can't hear you.
Can you hear me now?
Is it my computer maybe? It is my computer. Hold on just a second.
Can anyone else hear me?
I think I've figured.
The TV.
Okay. All right, try again, Tyler. I'm sorry.
Can you hear me, Kayla?
I can.
Oh,
We're missing
perfect. Sorry about that. Wrong time zones. My bad.
I know. I know. And I didn't even say which time zone. I just said Ohio.
No worries. No worries. I should have figured. I should have ran out my little map and then got a little more dialed into it.
Yeah, you're fine.
Let me pull up a screen share real quick.
Perfect. We've got 3 in person and 3 on Zoom.
Okay.
So if anybody on Zoom, like I'm gonna watch the chat, Tyler's gonna go through his products. If you like have a question and you wanna chat, type it in the chat or raise your hand and unmute, like feel free. And then Tyler, I kind of just laid out like for the next 15 minutes, we'll probably just go over like, hear what you have to say. And then I'd really like to open it up for discussion because already in the room, we have a couple, like one person that has a transaction right now that had to go to a 1099 loan.
Okay.
And so we have some applicable scenarios, and I'd like for those to be shared so that everybody can kind of help find the value and help apply it in those situations with those clients where it might be a great option for them.
Yeah, absolutely. Absolutely. Let me just start the slideshow. Give me 1 second, okay?
Sure.
Are you guys able to see that?
Nope.
Nope. Okay, hold on. Let's see. Should pop up right now.
There we go.
All right, you see it?
Yes.
Perfect. Okay, very good. So yeah, like Kayla said, so my name's Tyler from NewFi Wholesale. So essentially we help Keller with outside the box transactions, everything outside of agency from, DSCRs to bank statements to condo tells, ITIN clients. So really we cover a vast majority of what they can't cover in-house. Kayla is always your main point of contact. So if you guys need pricing or questions on a program, you'll reach out to Kayla, she'll reach out to me, and we'll talk about, a good fit for the client. I usually do these 2, LOs, so we go a bit more in depth on, actual qualifications, DTIs, things like that. So with agents, I'm going to scale it back quite a bit and just kind of give you an overall picture of what else to look for out there on the market. And then any questions, let us know. Hopefully we'll get these clients to apply to, your clients, but then are these loans applied to your clients, but then also to yourselves as well? So as far as the loan types on our side, we will take care of, full doc loans, asset depletion loans, bank statements, 1099s, etc. A really good one for real estate agents to help qualify themselves and also their clients as well. What Kayla mentioned is a 1099 loan. A lot of agents are new to the business, only been doing it for 1 year, maybe 1.5 years, and don't have that full 2-year picture. So this program actually will allow them to use a 1-year program with 1 year of a 1099. And we give credit for up to 90% of the income on your 1099. So let's say you made $100,000. We give you credit for $90,000 as your annual income on your 1003. And we just make sure that supports DTI, and we write it like a traditional loan would. So if you guys are marketing to, let's say, like Uber drivers, Lyft drivers, other contract or gig workers, self-employed but not fully self-employed, these are a really easy fit, very straightforward. You give them credit for a lot more income. Still very popular one on that side, but then also the bank statement loan. So same idea. employed for 1 year, 2 years, no matter. We will collect either 12 months of their business or their personal bank statements. We will calculate those, give Kayla a number for her to put on her 1003 for their qualifying income. So, I know a traditional audience, we look for, the W-2 client that's super easy, straightforward, 780 FICOs, looking to purchase, 500 plus. But, as far as your guys' marketing efforts, you find your contractors or your self-employed clients, start directing some of that marketing towards them as having an option for qualification to help generate some additional business, knowing that you can use alternate means of qualification for income. So asset depletion, very standard. You guys have, clients that have a lot of money, but they don't have any actual, paper trail income. We will take their qualified assets and divide them by 84 months, and it's a qualifying income. I think at Keller, it might be like 240 or 360, so it's a lot harder to qualify. The great part about any of these loans is we can combine income. So if you have a W-2 employee or worker that has a side job that they're self-employed on, we can throw a 1 year 1099 on top of a W-2 or a 12-month bank statement on top of a 1099. However you want to, work it, all of these are combinable. Yeah, and then, really just other, other types of properties. We do non-warrantable condos. We do condotels, attached ADUs, detached ADUs, permitted, non-permitted. I guess another important factor is that we will do properties that are zoned commercially if their best use is residential. They can't be operating any business. They can't have any actual commercial use out of them other than the fact that they are zoned commercially. Using residential, as long as residential is best use, we do have an option for lending on them. The other programs, and we'll get to the DSCR next and we'll go through, but really just a gist of the 1099 and the bank statement, self-employed clients geared towards. It was very common in the business. We kind of pushed off all the self-employed clients because we just don't want to deal with the tax returns and all that mess when W-2s were so easy to come by. Now we're kind of refocusing our direction. So if you have them, don't be shy. These are 10 times easier than going through full returns, P&Ls, expense sheets, balance sheets, things like that. Do you guys have any questions so far? All good?
Tyler, can you just do a quick overview for like what differs a warrantable and a non-warrantable condo? Like what scenario would they want to use that program in?
Yeah, so Fannie Mae and Freddie Mac, they have selling guides for what they call warrantable condos. It just really means that the condo needs to be financially, physically sound across the board. They want no hiccups in any kind of pending litigation, health hazard, or financial issues. They want their condos to not be overrun by investors or the primary use on that condo to be investment properties. So there's a whole bunch that goes into what makes a condo eligible on your side of the business, on the Fannie Freddie side of the business versus the non-QM side. So anything you guys run across on a condo that is a health or safety hazard issue, it's pretty much off limits besides a hard money lender who's willing to do something like that. Even us on our side, we don't touch them. But for example, the Fannie Mae requirement on condos, not more than I believe it's 50% of them can be non-owner occupied units. Over to a non-warrantable, we allow up to 80% of those to be non-owner occupied units, investment properties, if you will. We allow for a greater amount of single owner entities on those condos as well. So it's really just comparing us against, the Fannie requirements on a condo. But the nice thing is, as agents, they'll usually tell you when you go under contract with a client, they'll usually say, hey, listen, this property is not going to qualify, Fannie or Freddie. It needs to go, non-QM or, all cash offers, if you will. It's kind of them saying that it's not going to fly on a condo review board. So when that happens, we'll still entertain it, find out the reason why it's non-warrantable, what are the issues with the property. If it's a lawsuit for someone falling, it's very difficult to do. But if it's more one of the simpler ones, I should say, people who own it, commercial space in the building, single owner entity, things like that, there's usually an option with those.
Great, thank you.
Yeah. So for the fun one that everyone gathered for the DSCR loan,
Wake up.
The DSCR, like I said, requires no income whatsoever, self-employed, unemployed, retired, own 50 companies, it doesn't matter. None of it is tracked on the application, none of it brought in. They cannot file their taxes for the last 10 years. It would never come up. You qualify based off of the income the property generates. So there's two ways with Keller to qualify for it. So you are either over one or you're under one. If you're over one, it means your property brings in more income than the monthly mortgage payment. Simple calculation, divide your rent by your payment, and that will give you your actual DSCR ratio. For example, $2,500 in rent versus $2,000 in your payment gives you a ratio of 1.25. You are cash flow positive. You're in a good situation. So you're over one or you're under one. Let's say that the home doesn't generate as much. We still do these. We can do these on vacant properties as well, not cash flowing. Your hit to it is a hit in rate, and then also a 5% reduction on your LTV, but it's still doable. So how they determine these on your guys' purchase transactions, when you go after them, you really want to have the selling agent, or hopefully you can pull some numbers. You want to find out what a good market rent is for the property, the area, rental comps, if you will, not sales comps, and find out what it should rent for. You'll report that back to Kayla, and then we'll try to make sure we can get a mortgage payment that is hopefully under that mark to cash flow in the loan, give your client the best rate with the best terms available. So how we actually get that number is, we'll get the comps from you guys, just have a good foot forward. But the hard number is the 1007 report from the appraiser. Traditionally, we order a 1004, which is a traditional appraisal. We'll also order a 1007 as well, which is a fair market rent schedule. The appraiser is going to tell us what the rents should be for that property in that area. And that's the number that we'll use our transaction on.
Does that answer your question, Preston?
I was gonna ask for Airbnb in Virgo. What?
Yeah, I got a slide for that one. Give me a second. That one's coming up. That one's a big one.
Preston's ahead of us.
Yeah, no worries. Oh geez, wrong one. I got rid of it. Okay, so ineligible properties. This actually comes up quite a bit. Log homes and log style homes. So these are built for, investment, long-term, short-term. They're not built for, remote properties. They don't want big, big pieces of land, harder to rent out for a short-term or long-term basis. Acreage is restricted as well. Leaseholds, property conditions, C5, C6, that's just a poor quality property. Traditional single family condos, townhomes, 1 to 4 unit properties, then also 5 to 8 unit properties. So this might be cool for you guys to be able to kind of get involved to that more commercial side of the space if you aren't already, to where you can start doing those 5 to 8 unit properties on this DSCR loan. I would say the only difference is on that, the DSCR loan for a 5 to 8 unit property, all of the units must be occupied, or at least 80% of the units must be occupied. So purchasing a 5 to 8 unit property that is vacant is not an option. It needs to come with tenants in place. That way we have a better feel for the rents of property we're going to generate. And again, that is only on a 5 to 8 unit DSCR loan. 1 to 4 can be vacant. We'll let the appraiser tell us what it's going to generate. And then the fun one, so AirDNA. So this is a really good tool for you real estate agents, Kayla, you as well, which you guys probably should subscribe to. I think it's free for at least this tool. You can pay for a few additional resources on it. So the big one now for DSCRs is using short-term income. Appraisers 99% of the time will not put down what short-term rental income will be on a property. They just don't have a lot of data on it, so they won't put it on the report. So what we'll do is we'll use a tool called AirDNA. AirDNA, it's actually really cool to use. You actually plug in really any property in the entire country, bedroom, bath, etc., and it will tell you what you should expect for rents received from a short-term rental, with everything from your expense factor to vacancy rates and things like that. So this one gives us more information before the transaction starts, because we have a better idea of what that property is actually going to generate. So this is a picture of the actual report that comes out. So annual revenue on this property is $77,900. What we will do on a purchase transaction, we will use 80% of that number for a qualifier, towards our ratio, our calculation. But interesting to note, so most properties on average that are in short-term rental areas that bring, let's say, $2,000 a month, short-term rentals bring $3,400 a month. So if we have a property that qualifies, we're better off going with it because it does help the transaction work easier with better ratios going forward.
That's good stuff. That's awesome.
Yeah, it's super helpful. Like I said, I know people want to start marketing towards them, like, hey, let's start finding it. Well, first off, we have to present figures to our clients, right? We have people that want to start investing. Well, where do they start? We have to put them into a good investment opportunity. So what do? We do research on the properties for sale around their price point in their area. We punch these numbers. Okay, well, this property right here is going to generate an extra 7,000 versus this one, to where you provide additional value to those clients looking to buy those investment properties.
Tyler, we're in the football Hall of Fame city.
Oh yeah.
So as long as the county doesn't shut us down, this is kind of a strategy for some people in the area with some single families around the Hall of Fame village that's like always developing.
Yeah, great point. Yeah, and it could be, and like I said, you put those numbers in and you'll get your generated rental income, and then you can really just sell to clients like, hey, I had a property right here that's going to generate XYZ. If they're a true investor, and that's really the people that you want to capture on these types of loans, is investors with investor portfolios that understand the business. They're looking at buying 2 or 3 properties, and you can continue to get business them for the foreseeable future. If you show them these types of numbers and reports, you're 3 steps ahead of the next agent who's like, oh yeah, it should be an okay investment property. Let's show them some numbers on paper and what you can actually provide and the value you can bring to them.
To definitely help them set themselves apart.
Yeah, absolutely. Yeah. So on these types of loans, I don't know if they're going to ask you guys this again. I'm used to selling this to LOs and not real estate agents, but max LTV on these types of loans is 75%. So they do need to put down 25% as a down payment. Traditional investment properties are 20%. This one's 25%. So hopefully not a huge hang up on that. But yeah, really, really nice option. It needs to be in an area where short-term rentals are common. And that occupancy rate, if you guys decide to play with this tool, the website's called AirDNA. It is not a NewFi specific website. I would assume it's probably a branch off of Airbnb, rental incomes. This one's just a tool to provide additional information. But yeah, airdna.com, and you can sign up. It's called a rentalizer on AirDNA, where you guys start plugging and playing with some properties. The occupancy rate down at the bottom right-hand corner, that occupancy rate for these transactions to work needs to be at least 60%.
Okay. We have a question in the back too.
Yeah.
Say 25% down, is that just on the Airbnb or for any DSCR?
Good question. So traditional DSCRs can do as little as 20% down. The short terms are at 25%. Not to confuse you guys too much, we have what's called an experienced investor and a novice investor. So an experienced investor, someone who has owned at least 2 properties for at least 12 months in the last 3 years, one of those being an investment property. If that's the case, then they are an experienced investor. They can put down 20% on a traditional DSCR, 25% on a short-term DSCR. If they are a novice investor, meaning they haven't owned an investment property before, which is a majority, then they will have a 5% haircut to that LTV, meaning their traditional DSCR is at 75 and their short-term DSCR is at 70. These loans as well, guys, just because I just thought about it. So these are not built for any fix and flip financing. The DSCR product is for longer term investments. We want to see these loans held for usually at least a year. So if you have a person looking at buying a house and then flipping it and selling it 4 months later, these are not a good flip. These are not a good option.
You have another question?
Yeah. So what's the benefit, what's the drawback of these, like the rates that people get, that sort of thing? This is giving people an opportunity, but there's more risk being taken on it. So as I'm trying to talk to clients about this, what is the drawback on doing this type of loans?
Good question. Yeah, good. Mr. Caleb?
So Tyler and I actually had this scenario pop up a couple weeks ago where we were just missing the conventional investment, bucket just by a hair. And that investor would have been, with their interest or their credit score, they would have been around a 7.5 with me. And then when Tyler and I looked at the product for DSDR as an option, it was, I believe, at 9.5% that week.
Yeah, and a lot depends on your prepay penalty. You can go from 0 year to 5 years. So a lot will depend on that. I'd say rates usually average on those loans right now. They're usually about 1.5, 1.25, 1.5 higher than an agency loan. But what you guys want to keep in mind for these transactions, these are a supply and demand type of product. Your guys' client who qualifies for a paper, you know, they can cover with their liabilities or income strong, they can cover it with a traditional loan. Then Kayla can handle it just traditionally in-house. The benefit that DSCR brings, which seems like a big benefit, is that people, you know, write off way too much on their business tax returns. There's way too many expenses. They own more properties than Fannie or Freddie will allow for. You know, they own 20 businesses and don't want to go through the work of that full doc. So albeit the rate is higher, you're essentially selling the ability to be able to at least complete a transaction for them, and not necessarily showing them, you know, a rate that's lower than the agency transactions and things like that.
And it obviously is a case by case, because if you have, you know, multiple units, you're talking over 5 units, and you have a much larger potential for cash flow, that 2% in a short term, you know, maybe 3-5 year plan, yeah, could be exactly what you need to start building the equity and cash flowing that property.
About prepaid penalties.
Scott says, what about prepaid penalties?
Yeah, so the prepay penalty option. So there is essentially 0 to 5 years. 5 years, the longest one offered. You know, 5 year offers the best rate out there. Really, on the 5 year, I'll try not to confuse you guys too much. So on the 4 and the 5 year prepay penalty, the penalty is 5%. Whatever your client overpays on top of their required monthly payment, they are hit with a 5% penalty. So if they overpay $100, they're hit with a $5 fee. If they overpay, you know, 100,000, they're hit with a $5,000 fee. If they pay out the house, 5% of the outstanding balance, refinance it 5% for 5 years. It's 5% the hard way. There's one that I like to sell a little bit better, and the rate's almost as good. It's called a 3-year prepay. On the 3-year prepay, if they were to pay it off, the prepayment penalty is 6 months of interest. However, the loan allows them to pay it down up to 20% per year with no penalty whatsoever. So that's our easier sell on that side. And you can buy it out and do a no-year prepay, but you know, for these loans, usually let's say at 9.25, there's no points on it. Everything's rolled into essentially the rate. If you go with the 0-year prepay, you're probably looking at 9.25 with probably, let's say, 2 points in cost. So you're gonna pay those 2 points up front, or you might pay it on the back end, but it is, you know, there are options and hopefully a fit for every client. You can go with a 0-year. Our big number that we want to make sure we ensure, you know, everyone keeps their commission on the transaction is 7 months, 1 day. We want them to hold the loans for at least 7 months, 1 day to keep the investors at bay.
All right. No other questions? Want to check the chat? Nothing? Okay.
Nothing there. Okay. And then, yeah, this is back on the I-10. I'm sorry, the 5 to 8 unit property. Max LTV is at 75 on those. Experienced investors only. And the 5 to 8 unit properties have to cash flow. There is no less than one option for a 5 to 8 unit property. The big one that gets a lot of people, minimum loan amount. Minimum loan amount's at $400,000 on a 5 to 8 unit property. It is at $100,000 on a DSCR that cash flows. It is $150,000 on a DSCR that does not cash flow.
Now, do you have to personally, like, not qualify, but can you buy one of these or use one of these loans with an LLC?
Good question. So it's a great question. And the misunderstanding, at least on our side of the business that I get a lot, is that they do these loans for LLCs. So non-QM lenders, 99% of them out there, they will allow you, as will we, will allow you to vest these properties in an LLC, but we do not lend to LLCs or entities. So the client will have the loan under their personal credit as a mortgage like they always would. However, the vesting of the title of the property would be in a business, not an individual, but it's still a self-reported liability. It's a good question though. Yeah, because everyone's like, oh, I'll just go ahead and create an LLC and then buy a bunch of properties with the LLC. Nothing will show my credit. My DTI is still in great shape. Let's keep doing this. Unfortunately, a little too good to be true on that side. And then
Tyler.
what's that?
You're the killjoy, Tyler.
I know. I wish we could do it. I mean, that'd just be a wonderful thing. Yeah, like I said, everyone's asking for, short-term rentals with 10% down and they want to sell them in 6 months. I'm like, that would just make too much sense and it just wouldn't work out. But yeah, another big one that we're seeing a whole lot of right now, guys, is ITIN clients. So people who do not have a social security number. The cool thing about these loans, we do them on bank statements, 1099s. It seems like a majority of ITIN people are self-employed, contractors, what have you. So we can absolutely touch that market as well if those are out there. You guys do come across those. And there is, usually I give marketing to the LOs. I mean, if you guys want to touch on one of these programs, in specific, I can get Kayla over some information. Kayla, did I send you over the marketing stuff already?
There's an email that you were getting some of it, but I don't think I got any attachment.
Okay, I'm just gonna send you one with the blue links in the body on there. I'm not sure if they would cross over to the agents being able to market the product as well versus you marketing the product to agents instead or to clients instead, but I'll get that over for you guys so you guys can take a look at it, maybe come up with some ideas to put something together like that. If there's a community that has a greater population of ITIN clients that are around you guys, maybe kind of getting the word out down there and things like that.
Yeah, thank you.
Yeah. But that's pretty much all I got. Bank statements, 1099s, DSCRs. Kayla will know that, if we can't qualify them in-house, to reach out and we'll see what we have to qualify on our side of the business.
Yeah. And I mentioned before you joined, Tyler, that I have reached out to him a handful of times just because I don't like to let anything go easily. And if it doesn't fit our buckets, and we have several buckets, Tyler usually has a solution. It's just whether or not it makes sense and it fits for the client. So he's been very available and very, very helpful and informative. So utilize me, utilize him. Does anybody have like any scenarios to share with a group where they've applied any of these products with successes or pain points or anything at this time? Lots of questions.
Myself, so
Yeah.
Successful.
Yeah. Preston is excited to use the program himself. And I know when you started on that slide, Scott's jaw kind of hit the ground. And
Which one?
DSCR with no income and.
Oh yeah.
I didn't know that an experienced investor, which I would qualify, is a 80% loan to value instead of 75.
Mhm.
So that's pretty cool.
Yeah. Yeah. And that was a first for me. What defines an experienced investor? So.
Yep. 2 for 12 and the most recent 3, but I don't talk about it because you guys are involved in the refinance market. But important thing on these are good on cash out transactions, on rate and term refinance transactions. So I should have brought it up, and I guess next time I talk to agents, I'll remind myself too, but a good play for you guys, I guess, if you guys know people that own investment properties or have portfolios, you might want to talk to them about maybe pulling out some cash out of those properties and try to buy some additional properties. That way you're generating some additional business for yourself as well. So we on a refinance transaction, on a cash out refinance for a DSCR, we will use the current lease that is in place with 2 months proof of receipt. And we'll compare that against the mortgage payment that we all create together on the property. And we can pull out cash that way, but that's a really good way to help generate and drum some business. I know a lot of investors, they want to buy more, they just don't have cash available. You reach out to them, see if they're interested, and you really just want to find out who are you using for your DSCR loan. They're going to ask you what a DSCR loan is, and you can kind of give them all the great news and they won't believe you, and hopefully help generate some additional business on that side. But yeah, cash out, a really nice option to go and buy some additional investment properties.
How long do you have to have that loan for the cash out option?
So you're talking about seasoning on the current property?
Yeah, the seasoning.
Yeah, so the DSCR loan is at 12 months. So as long as you've been on title or own the property for at least 12 months, you can pull cash out with a new appraised value on that home.
Preston's gonna put in an application when we get off this call.
Wait, let's do it. Yeah, oh yeah, the best part about it, so interest only. So on lower loan amounts, it doesn't help out a lot. So a lot of these loans, 90% we do because it's all about the payment that we create on the property. 90% of them will have a 30-year interest only loan option attached to them. The interest only, if that's the direction you go, that payment is used for your DSCR calculation versus your rents. So it is a really nice option. How the IO works, the first 10 years are interest only, and then it goes to a fully amortized 20-year term. So 10 IO, 20-year fully am, 30-year interest only option.
Excellent.
Yeah, 40-year fixed as well, all the fun stuff.
And this is a lot of information. And again, it dives even deeper when he starts talking in loan language. But you don't have to remember all of this. Obviously, the goal today was to get enough information to know those scenarios where you can use these tools to differentiate yourself. And then you can, see the value. And if you're working with investors actively and they don't know about this, and you're the one that comes and educates them on how to leverage their asset to grow their portfolio, that's invaluable, really.
Yeah, 100%. Yeah, because most people that you guys come across that own investment properties, they're either usually one of two. They're either in hard money at 13 or 14% rate, or 8 or 9 will beat that all day long, or they are in a balloon payment. So on a refinance, it helps you guys out. But just keep in mind that when people aren't using traditional financing options, they are going with really hard loan terms as far as high rates at hard money or balloon payments at hard money as well. So if you can give them a true 30-year fully amortized loan option that doesn't balloon and the rate's not high, you'll win a whole lot more business.
Absolutely. Our Zoomers, do we have any other questions out there? Okay. Tyler, thank you so much for joining us. I really appreciate your time. I know we all do. And thank you for everybody that took time out of their busy day. If you have any other follow-up questions, or you want to have a sit down with Tyler and I, be happy to go into detail and depth on any of your clients.
Perfect. Thanks guys for having us. And if you have any questions, revert them over to Kayla and we'll get together and make sure we get you over the right information.
Great. Thank you.
Thanks guys.
All right. I had the stop button and the stop button went away. Cancel. I don't know. They're still there. Okay.